In 2023, the world faces a pivotal moment in the electric vehicle revolution. As subsidies wane and economic headwinds intensify, the burgeoning industry stares into the abyss of the valley of death. Demand for electric cars, once skyrocketing, now teeters on the brink of stagnation. This dramatic shift threatens not just manufacturers, but the very heart of the world's green transition. As the continent grapples with soaring prices and supply chain disruptions, the dream of an electric future hangs in the balance. Jim Farley, the CEO of Ford, emphasized a crucial point during their Q3 earnings call recently, where he stated, "Having a great product isn't the only game in town when it comes to EVs. We've got to be absolutely on point with our costs." Ford, in a strategic move, has put a temporary hold on $12 billion worth of investments in EV initiatives, waiting until there's a clear demand for more capacity. Ford's recent earnings report revealed a somewhat surprising trend. American buyers of electric vehicles aren't too keen on paying extra compared to traditional gas or hybrid vehicles. This reluctance is putting the squeeze on EV prices and, consequently, their profitability. Will the industry navigate through this treacherous valley, or will the world's electric ambition fade into a cautionary tale of innovation and loss? Rewind to early 2020, and the world was rocked by a global event that needs no introduction. This event led to shortages across the board, shaking up global supply chains, and the car industry was no exception. A key factor here was the global chip shortage, which put the brakes on many car manufacturers, leading to a sharp drop in the production of new cars. This scarcity made used cars the new gold, as buyers scrambled for available options. The result? Used car prices went through the roof. To add fuel to the fire, global events like the Russian invasion of Ukraine only worsened the chip crisis, further jolting the car industry. To attract buyers in these tough times, dealerships got creative, offering extended 0% interest loans for up to a whopping 84 months. These extended loan terms became a lifeline for closing deals and reeling in customers. Dealerships didn't stop there. They rolled out tempting purchase and lease deals for new buyers, packed with benefits and discounts to make car ownership more appealing. Even during lockdowns, dealerships switched gears quickly, finding new ways to keep sales rolling remotely. But then, in 2021, as life began to return to normal, the car market saw a drastic shift. Missed buying a car in the first quarter of that year? You might have missed a golden window. What followed was a steep hike in prices for both new and used cars. Factors like disrupted global shipping, the ongoing chip shortage, and the conflict in Ukraine have left a lasting mark on the car buying experience, becoming more apparent over the past couple of years. Take January 2022, for example. New car buyers had to pay over 12% more than the previous year, and used cars, their prices shot up by over 40% year over year. The slowed down car production, thanks to the chip crisis, created a huge gap between the demand and supply of cars, sending prices to new heights. But now, the scene is changing. The chip shortage is easing up, allowing car makers to step on the gas and increase production. This boost in production is serving a dual purpose, fattening the wallets of automakers and meeting the pent-up demand of eager consumers. It seems we've already hit the peak of car prices, with early signs of a gradual price drop. But this is just the beginning of what might be a major price plunge. Nationwide, there is a noticeable shift in car prices, especially in the wholesale market. These prices are steadily veering downwards. Auto market mavens like those at Manheim Consulting have their eyes on a significant change. New car models might see a dip in prices by about 9%, and used cars could face a steeper slide, possibly around 26%. This trend in wholesale prices is like a green light indicating that retail prices are set to follow suit. April brought a landmark moment. For the first time in almost 2 years, the average price of a new car sneaked below its sticker price. This move signals a pivotal shift, pointing to a time when sky-high car prices might become a thing of the past. From January 2021 to January 2023, we watched used car prices jump a staggering 52%, while new car prices revved up by nearly 28%. However, when you put this against the backdrop of the median household income in the US, which only grew by 13%, and that's not even counting inflation, the picture becomes clearer. In real terms, after considering inflation, household incomes only nudged up by about 7.1%. This gap has driven car affordability off a cliff. Over the last few years, used cars have become almost 40% less affordable, and new cars 15% more out of reach for the average buyer. These trends are like flashing hazard lights, signaling a market crash might be just around the corner. Experts are sounding the alarm bells loud and clear. With inflation biting and cars becoming increasingly unaffordable, they're predicting a major market crash. The big question now is not if, but when. Analysts believe a significant correction is already in motion, but the full extent of the crash could be unprecedented, possibly even eclipsing the chaos of the 2008 auto market crisis. As we cruise through the current car market landscape, there's a clear shift from a supply drought to a deluge of inventory. This change is thanks to easing supply chain pressures, leading to a bumper crop of vehicles. However, this sudden surge in inventory is accelerating the drop in vehicle values faster than many predicted. A recent UBS report forecasts that global car production might exceed sales by 6% this year, which means about 5 million extra vehicles needing price cuts to clear the lots. While these price cuts might not slam the brakes immediately, car makers are gearing up for a potential price showdown. The electric vehicle market has already kicked off this trend with some notable price cuts. UBS is cautioning its clients about the risks of overproduction and the rising pressure on prices. The price battle, which has started in the EV arena, is expected to rev up in the traditional combustion engine car sector by the latter half of 2023. The dynamic shifts in the electric vehicle market are highlighted by Tesla's recent pricing adjustments. For instance, the Tesla Model 3, a popular choice among EV enthusiasts, has experienced a decrease in value by over $9,000, losing nearly 20% of its price since the beginning of the year. However, this trend of depreciating prices isn't exclusive to Tesla. Other EV manufacturers are experiencing similar patterns. In 2022, a pre-owned Jaguar I-Pace had a market value of around $69,000, but just a year later, its price has declined to approximately $53,000, a reduction of about 23%. Similarly, the Volkswagen ID.4, initially priced at around $41,000, is now expected to undergo noticeable price reductions in the coming months. The impact is not limited to the new EV market. The used EV segment is also facing significant price shifts. For example, a 3-year-old Chevrolet Bolt, once priced at about $25,000, is projected to drop to around $17,000 by the end of the year. Such a decrease can be challenging for recent buyers who may see the value of their vehicles diminish more rapidly than anticipated. Although the recent shifts in car prices are noteworthy, it's important to zoom out and see the bigger picture. Since 2020, the value of used vehicles has skyrocketed by almost 90%. With this in mind, both car owners and potential buyers should gear up for potentially steep declines in car values in the coming months. For those mulling over the idea of buying a new or used car, now might be the prime time to keep a keen eye on the market and jump on a great deal when it appears. So, what do these seismic shifts in the car market mean for you, whether you're a buyer or a current car owner? If you're looking to buy, the landscape is gradually tilting in your favor. The expected drop in car prices could unlock doors to models that were previously out of reach due to inflated costs. It's a game of patience, but timing your purchase well could land you a dream vehicle at a bargain. For current car owners, especially those who bought at the peak prices, the picture is a bit more complex. The value of your vehicle is likely to dip, possibly leading to a scenario where your car loan outstrips the worth of your car. If you're planning to sell or trade in your vehicle soon, brace for a lower return on your investment. The looming market crash is a vivid reminder of the automotive industry's unpredictable nature, where external factors like supply chain disruptions and global events can dramatically shift market dynamics. As we approach the end of 2023, the market is gearing up for a significant turn. An oversupply of vehicles, coupled with dwindling demand, is paving the way for a buyer's market. For those in the hunt for a new or used car, the upcoming months might offer some of the best deals in years. Car prices are expected to level out, making it easier for many to afford their preferred vehicles. However, staying informed and tracking market trends is key to making the most of these changing times. In summary, the automotive market is on the brink of a transformative era. After years of escalating prices and tight supply, we're standing at the edge of a major shift. Whether you're eyeing a new purchase or currently own a car, these changes will have an impact. It's a time for cautious optimism as the market adapts to new realities. Stay alert to market developments and be ready to make your move when the timing is right. What are your thoughts on this upcoming shift in the car market, and where do you see it going in 2024? Share your insights and perspectives in the comments below.